Hey Archie, what if I have an insurance policy or an annuity that I don't need anymore, or I wish I hadn't bought so many years ago? What can I do?
Well, Rob, let's talk options.
I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way.
Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals Archie Hoxton and Rob Hoxton. And today, we're going to talk about what to do with the insurance, life insurance, and annuities that you have that you're not really sure that you want anymore or need anymore. What to do with them. We get that question a lot. Someone might come and say, hey, I've got this life insurance policy or this annuity. I'm not really sure why I have it. I pay for it, and I'm not really sure why I pay for it. So
It's funny. I mean, we get that question a lot, and there are lots of different answers, of course. Maybe there was a need at the time. Maybe the salesman was really, really good at sales. Maybe it was because your nephew went into the insurance business, was in it for about 3 months, and then found something else to do. There are all kinds of reasons why you might have a policy that you don't really need.
Yeah.
And so let's talk about that.
Yeah. Well, I think, because you have some options available to you, but there are a lot of kind of little potholes that you can hit if you're trying to get out of something. And so, especially if it's insurance under the insurance umbrella. So you got to watch out for those and be informed.
And it's possible, actually, that you just need to be reminded of why you have the insurance, because you may still have that need. So don't assume that just because you have this premium, you don't remember why you bought it, that it's something you don't need anymore.
Right. And that's, I think, the first option that we'll talk about is just keeping it. Because when we're talking about insurance, and I think specifically we're referring to life insurance and annuities, because these can be on the expensive side, and they're often sold to people who don't know why they bought them. So, we'll set aside kind of the property and casualty, home and auto, and that sort of thing. That we're not including that here. Just strictly the life insurance and annuities.
These insurance products often have cash values associated with them, and yeah, so it's important to dig into.
Yeah, exactly. So, the first thing to do is think about, start educating yourself on why people would actually own something like, let's start with life insurance. Why would you need life insurance? Well, the most basic reason that you need life insurance is if someone is relying on you to provide for them, whether that is, paying the bills, making sure the mortgage gets paid,
College education,
retirement. So if you have a retirement plan and you and your spouse are planning to retire at a certain age, making sure that if you pass away and your retirement goals are you're not there yet, and you're counting on being able to continue to save to meet those goals, you might want to keep some life insurance. So that's the first thing. Annuities, they're a little different. There's a ton of flavors. Most of the time, if someone buys an annuity, it's because they want to either make sure that they have income for the rest of their life that's guaranteed, or maybe they're really averse to investment risk.
Maybe they wanted tax deferral.
Yeah.
Yeah, there are lots of different reasons that you might buy an annuity. And so we can certainly dig into that. The cash value life insurance policies are the ones that we seem to get the most question. We get a lot of questions about that. So we have an older client who doesn't have an obvious need for a death benefit. Maybe they have a policy and don't have heirs who are really dependent on them for support. and yet they're still paying substantial premiums into a policy that is accumulating a cash value.
Right.
Let's talk about that a little bit, because that's a scenario that we encountered very recently here in the practice, in which you had a client with no children, widowed, and still making pretty large premium payments into a cash value policy. And they wanted to know whether, number one, whether they should still have the coverage when they didn't really think they needed a policy. And number two, if they don't, how do they get out of it, and how do they make sure that they don't lose that cash value that they've accumulated over the years?
Right.
And you mentioned potholes. There are lots of potholes associated with that decision.
Yeah. Because if you've come to the conclusion that, in fact, you do not need the coverage and you don't want to keep it, whether it's an annuity or life insurance, the next kind of most obvious step that people come to is to surrender the policy, meaning essentially cancel it, but take what cash value is available to you, and just sort of take that and ride off into the sunset. But there's a lot to consider.
There's potentially a substantial tax bill associated with that.
Right.
If the policy value is greater, and I'm oversimplifying, greater than the premiums that you paid in, then you're going to pay ordinary income tax on the difference. If it's an annuity, it's the same sort of thing. If the value of the annuity is greater than the premiums that you paid, you're going to pay ordinary income tax, which is probably your highest tax rate, on the difference between what you put in and what you're taking out. It's different than a traditional investment. If something grows in value with a traditional investment, you don't pay taxes at an ordinary income tax rate. You pay based on long-term capital gains rate.
Yeah, as long as you held it for more than a year.
As long as you held it for more than a year. So you got a different tax picture that you have to deal with. And there may be things like surrender charges or market value adjustments that you need to be aware of when you do this. And there are some ways to avoid some of that as well.
Yeah. So if let's say you bought this and you initially, you paid a commission. So the insurance company pays a commission to the agent. And then you end up with what's called a surrender period, where, maybe it's 7 years, maybe it's 10 years, where if you take money out of that contract, now sometimes you can take a certain amount out without penalty.
Yeah, we often see 10%.
10%
free withdrawal, common. Yeah.
Let's say you surrender the whole contract, the whole policy. In that period, there'll be some kind of charge. It's called a surrender charge, where they will deduct that from the cash value before they give it to you.
So that they get reimbursed for having paid the commission to the agent. Now, you may not have realized you were paying a commission because it's not that obvious.
Right. Yeah.
But they chances are the insurance company paid the agent a commission.
Right. So in those cases, if you're still in a surrender period, you have to decide whether it's worth it to you to surrender it and pay the charge, or to wait it out and wait until that period ends and kind of go from there. I mean, they're usually not terrible, like super, super huge charges, and they tend to kind of decline each year that you move into the period. So if you're in year 1, you might have a pretty hefty charge. If you're in year 9 out of 10, it's going to be pretty small.
Yeah, if you have a fiduciary financial planner, like if they have the initials CFP after their name, they're certified financial planner practitioners, they're held to a fiduciary standard in the way that they interact with their clients. That person should be able to sort of suss out what the costs are associated with terminating one of these contracts. You would do well to consult them for that kind of advice.
Right. And these occur in life insurance, they occur in annuities. There's another type of
potential charge.
It could be a charge, it could be the opposite of a charge. It just depends. But explain the market value adjustments.
So market value adjustments they are exactly what they sound like. They are an adjustment to the amount of money that you receive if you take a large withdrawal or you surrender an annuity or life insurance contract within a certain period of time, usually. But when you take that, the insurance company will deduct whatever surrender charge there is, and then they'll apply the MVA, the market value adjustment, if there is one. So the scenario is this: if you buy an annuity, and I got to look at my notes because sometimes I get this backwards. It's complicated, actually. If you buy an annuity and the interest rate, or the insurance policy, and the interest rate at the time that you buy it, prevailing rates are high, and then rates go lower, then you probably are going to get a little more money than you thought you were going to get. So the market value adjustment is a positive adjustment. But if the reverse is true and interest rates were lower, like let's say you bought the product 10 years ago when interest rates were lower and now they're higher, you're going to get a market value adjustment that is a subtraction from the amount of money that you receive. And it can be 1 or 2%, 3 or 4 or 5. It can be quite large depending upon what the annuity contract says. So again, if you talk to a fiduciary advisor, if you talk to an insurance salesperson, you have to understand that there is a potential conflict of interest in the advice that they provide you. But if you discuss with a fiduciary advisor, such as a certified financial planner practitioner, you're probably going to get the straight answer on this. But you want to know, number one, do you have surrender charges? Number two, do you have a potential market value adjustment? Because those could have a material impact on the decision that you make.
Yeah.
Whether to surrender it or not.
I think the moral of the story with these options between taxes, surrender charges, and market value adjustments is don't make a rash decision. Move slowly, because these things are complicated and sometimes they can be kind of embedded down in the policy, and you just need to be really mindful. So like, let's say you decide you don't want to keep your existing policy, but you don't want to surrender it either, because maybe you've got potentially a significant tax bill if you surrender it.
Is there a way to avoid paying the taxes?
There is, if you're willing to have a life insurance product, a different life insurance product or annuity. You can do what's called an exchange, a 1035 exchange. It's named after the
code section.
The code section in the Internal Revenue Code. What you can do is, now there's rules with this. So if you have a life insurance policy, you can get a different life insurance policy, or you can get an annuity. If you have an annuity, you can only get another annuity. You can't go to life insurance. So, but this opens up options for you. If, let's say, you look at the policy and you're like, I don't really need this life insurance, but I don't want to pay the taxes. So here's an annuity that I think is attractive and it meets my needs better now. I can exchange it, avoid the tax bill, and keep that tax deferred status through an annuity. Or maybe you'd want a different life insurance policy,
and you may be able to do it in such a way that you don't have a new commission or a new surrender charge that's triggered.
Right.
This is a really important distinction. So if you do a 1035 exchange from one annuity or life insurance product to another, don't jump from the frying pan into the fire, right? Jump from the frying pan onto dry land, right? So, because there are annuities and life insurance products that don't have these hefty commissions.
Right.
And you want to try to avoid that.
Yeah, again, move slow. Be really mindful of what you're getting into and making sure you're not, just jumping right to the fire. Because what you could do is you could get a different style of product. You could go from life insurance to annuity. You could go from life insurance to another life insurance that maybe has some additional benefits that are more suited to your needs now, maybe long-term care rider or something like that. You can if you have life insurance, you don't need it, but you're really averse to investment risk. There are certain types of annuities that can offset some investment risk.
And we should say very clearly that we're not selling anyone insurance products. This is educational information. This is to help give you an edge as you negotiate these transactions.
Because what you want to make sure is if you're going to do this, you want to go from, decent or from bad or decent or whatever you currently have to better, or ideally best. And by doing that, maybe finding a way to reduce fees and just being really cognizant of what's out there, moving really slowly and mindfully, and not just, buying something from the first person that picks up the phone when you start the search.
Yep.
You don't want to go to new surrender period, higher fees, new commission. You want to be really careful about that.
Yeah. So, get some advice. Stuff's complicated.
Yeah. But you have options, and it starts with educating yourself and being careful and getting good advice and knowing what options you have if you're wanting to back out of it. So I think that's just about covers what we can hit on today.
I think so.
So if you like this, please remember to like the video, subscribe to the channel, hit the bell for notifications, leave us a comment if you have thoughts or questions.
Tell your friends and family.
Yeah, tell your friends and family. And we'll look forward to seeing you next time.
You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.